So we have learned that individual in new classical finance are assumed that they make their preferences using expected utility theory, and they want to pick that option or that prospect which gives them the highest utility. And we also have learned that there are some axioms which support the expected utility theory. At the same time, to measure the utility, I mean to compute the expected utility, we have seen that we need a number to adjust the uncertainty, and we think of uncertainty in terms of the probabilities. Can you recall from your statistics course that we can update our probability rationally for the new information using the Base theorem? Have you heard about Base theorem from your statistics class? Yes, no?
Heard about it and forgot about it, sir, probably.
Okay, in that case, what can you do? You can just look at that how base formula works. The base, the concept is that when we have a certain probability for certain event, when we have a certain probability for certain event, say probability for something, probability for A, and we want to know that what will happen to this probability of A when the new information, which is information I, has been appeared, or new information has come. Say, for example, Bangladesh expected that Bangladesh will grow at 8% plus in 2019. Sorry, 2020, 2019, 20. But when it appears that in March 2020, when the COVID-19 has brought in our country, whatever the way, we have learned that it will not be possible to achieve the 8% probably 8% GDP growth rate. So there was a certain probability estimated by the government policymakers for this 8%. Say that probability was 80%, which is here 0.80. So what do you think when the new information has come that there will be the effect from the COVID-19? That's why this probability might not this probability might not be true as expected. Do you think we should make an adjustment to this, or we should keep this 80% as constant, that we are going to achieve 8% growth rate with 80% probability? Should we adjust it?
We should adjust it, sir.
We should adjust it. For what purpose? Because
Getting
the
a statistical view, sir.
yeah, the way we assumed our probability, the context has changed for appearance of new information. That's why we should accommodate it. So how can we accommodate it? We should accommodate the existing probability, and we should multiply this by probability of information given the original probability, or the original probability of the event, and we should divide this number by the probability of the information that COVID-19 will affect, and what is the probability of that. So in this way, Bayes theorem works, and it has been given us by Bayes approximately 200 years ago. So people have been using this Bayes formula to adjust for new information to the existing probability for 200 years. And it has been assumed that rational investors always do Bayesian updating, and rational investors are Bayesian investors. Can you recognize that what Bayesian investors do? Bayesian investors adjust their probability numbers, update their probability numbers for certain event using this way, what I just have showed to you, to accommodate the new information. But what we have learned that expected utility theory does not represent the people behavior, because sometimes we see people do not confirm the axioms what have been assumed by the expected utility theory. Is there anyone among you who use the Bayesian updating to update your probability? Anyone uses a Bayesian updating probability to update their probability? Even the doctors? Okay, just to tell you one example from the doctor's perspective. So you are very likely to visit the doctors. Doctors are most likely to mention this probability number, 50-50. Is it true? Yes, no. What I have claimed, that doctors are likely to use these probability numbers most often, that there is a 50-50 chance that it will happen or it will not happen, or there's a 50-50 chance of success. Are you getting what I have claimed here?
Got it, sir. The rate of success in the cases of operations, they might say that there is a 50-50 chance you'll be okay, or
Okay. Do you see that over the time, when approaching to operation time, say it is the OT time, the condition changes, the condition changes for the
yes,
patient.
the condition changes, sir. As much as reports the doctors get, they try to be more confident or more. Uh, they try to be more confident about the outcome.
Okay, but most of the cases, doctors do not change this number. Have uh, have you ever heard that doctor is saying that now it is 70% chance that there will be success, and there is a 30% chance there will be failure? Or still you listen these numbers? Say doctor has said 50-50 at this point of time. At this point of time, here, for example, have you heard that doctor is saying that there is a 100% certainty, or now uh, we are 95% certain, 5% uncertain? Have you heard about these numbers, anyone?
I don't think so, sir. I don't. I haven't at least.
Okay, what about others' opinion? Other people are sleeping or left the session. You are there? Shubroto, you are there?
Yes, sir.
Okay. What do you think? Doctor changes their opinion after having the new information before the OT time. They change their mind from 50-50 to 95-5 or 70-30, or they tend to remain at 50-50.
So remain 50-50.
They tend to remain 50-50. That is very likely because they are not the Bayesian doctors. Have you got the statement? They are not the Bayesian doctors. Even the new information has appeared, they are not very likely to use the Bayesian technology to update their probability. So it is easier to think of the Bayesian updating, but it may not be very convenient to use the Bayesian probabilities in reality. So this is the way how Bayesian updating also used for estimating posterior expectation. I don't like to invite this for you. So two facts you have to recognize. One fact is that rational investors, for forming their belief, they use the Bayesian probabilities or base probabilities estimation or base probability updating. And rational investors form their preferences using EUT. What is EUT? Jannatul, what is EUT? Expected utility theory. Okay. So for preference, people use expected, which people? Rational people. People use the expected utility theory, and for updating their belief, rational people use the Bayesian probabilities. So we have got evidence that people do not use this. People do not confirm these axioms. That's why we see that most people are, or most of the people are different from what is expected by the uh, neoclassical finance or rational people, what have been assumed as a rational people. Okay. Now, neoclassical finance also assumes that when people have a new information, this information get adjusted to the price, or price get adjusted whenever the information appears in the market. Okay. Have you heard about that when the price reflects the information, there is a concept which is termed for the market, where the prices reflects the available information. That kind of market has a particular name in the finance. Can you recall that concept from your investment analysis? What kind of market we try to term that market?
Perfectly balanced market. That everyone has the same information.
No, I didn't say that. Everyone has the perfect information. That is the concept from economics, perfect market. I'm just asking for when the price reflects the information. Price reflects all available information.
Market efficiency.
Right, market efficiency. So that is the concept coined by neoclassical finance. And can anyone recognize that was the who are the people behind the market efficiency? Which people coined this concept? Who first said that market is efficient? Anyone?
Sir, farmer French.
Yeah. Have you seen these people? Have you seen this person photo in your class? This person, Eugene Fama. So this is the person who first coined the concept that market is efficient. So by that term, he wanted to mention that market uh, accommodate or the securities reflect the available information, and it is unlikely or extremely unlikely that people will be able to achieve abnormal return or excess return from the market. Can you recall this concept? I will try to elaborate later. This is the
Yes, sir.
kind of primary concept. Okay,
yes.
it is not possible to have the excess return or abnormal return. Okay. Now they assume that when the investors make trading, investors receive information, and when investors make trading, their trading captures the information, and their trading causes or transfers the impact of information on the price. In this way, prices reflects the information. So if you have a positive information, you will want to pay for you will want to pay higher price, or if you have a negative information, you want to pay lower price. So in this way, how information is transmitted to the price by mean of trading. So it is not necessarily that information directly influences the price, but information influences the price, or prices captures the information by way of trading made by the investors. So how many forms of market efficiency we have learned from the how many types of market efficiency we have learned so far?
Sir,
Not
3,
in this class. Okay. Weak form,
strong and semi.
which one should come here? Second, the strong or
Semi-strong.
semi-strong?
Semi-strong.
Semi-strong. Okay. Then strong. Now, here, which information we focus in which form? Just try to recall, otherwise you will not be able to understand the follow-up discussion. What kind of information are reflected when the market is weakly efficient?
Sir, historical.
Historical market information are reflected in the prices. Okay. And what about the semi-strong?
Non-disclosed.
Non-disclosed or disclosed public information?
Oh, sorry, disclosed, right.
Yeah. All public disclosure are reflected in the semi-strong. And what about the strong? Even the private information also get reflected in the price. Okay. Do we have the fund manager present with us?
Sir, I'm here, sir.
You're there. Okay. Can you tell me that what is your belief that our market is weakly efficient or semi-strong form, has semi-strong form of efficiency or a strong form of efficiency?
I would say the strong form of efficiency, as the mostly undisclosed information even reflected on the price level.
Okay. Is it interesting?
That is truly interesting. That should not be public, or nowhere else in the world is is the market like that.
Okay, but the thing is that it is for some selected stocks, not for the whole, right?
True,
For
true.
the selected stocks, it acts like market has a strong form of efficiency. Okay, now if the market is efficient, no person will be able to achieve the excess return. Now there are three conditions assumed in the efficiency of market literature which are necessary that market will be efficient only if these three conditions are present. So let me show you the three conditions. The first condition is that investors are rational and they do not make mistake. They do not make any mistake. Which people cannot do mistake? Rational or irrational or partly rational? Which people
Rational
do not?
people should not make mistakes.
Rational people never make any mistakes, right? Is it true? It is likely that if mistake,
Less likely to make mistakes.
right? Okay. So do you think it is available that there are all investors in our market who do not make mistakes? Is it present?
No, sir. No, sir. No, sir.
Okay, it is not present. Okay. Now, second one. Say there are two groups of investors. So some groups are making positive mistake, some groups are making negative mistake. Do you think price will be inflated or price will be deflated or price will stay where it should be? A group of investors are making positive mistake. Let me just give you an example. For example, the fundamental value at which it should be traded, for example, at 100 taka, for example. And some people want to say that it should be 120, and say some people want to say that it should be 90. And they one group, either group of investors are not dominant here. What do you think? They are trading between them. These people will want to trade at this price and these people want to trade at this price. Do you think they are trading between these two groups will tend to take the price close to 100, or it will
This
be
is
close to 90 or close to
neither of
120?
them. If neither of them are dominant, if neither of them are dominant, it is supposed to be near 100, right?
It is supposed to be near 100. Okay, because some are making positive or some are making negative mistakes. Okay, now the third condition, so in this condition, if it fills out, market will remain efficient. If it also fills out, market will remain efficient. Now the third condition is that people do mistake and people mistakes are correlated. And why people do mistake? Because people tend to be influenced by behavioral biases. Say for example, right now the rumor is spreading that the lockdown is approaching. That's why the market will remain closed, and we tend to lose our position. That's why a group of investors tend to sell their position very quickly, which is causing the slowdown of the trading and also pushing the price down. So you see, a group of investors are doing this together.
True, sir.
A group of investors are doing this together. What kind of behavioral biases tend to exhibit right now? What kind of bias comes in your mind? Anyone? Any idea? Okay, let me give you an example. So we do not know exactly what is going to happen after this. Some people have expectation, but most of the people do not know what is going to happen after April, because the uncertainty is looming. So what do you think? The situation is going to be more ambiguous?
Is it emotional bias, sir?
I would categorize it later.
But sir, there is a news about share market that there will be a huge investment that will push the market up.
Okay, I'm just thinking from one perspective. There might be information, but I'm just thinking of one perspective, that when the market is going down, a group of investors are thinking that the coming days will be very uncertain. And thinking of that situation, people are trying to close out their position. So what I'm trying to argue, that people have a kind of bias which is known as ambiguity aversion. People have a ambiguity aversion bias. So what does it mean? If it has been cleared by government that for example, I'm making it very certain that there will be no closure of the market and it will continue to trade as it is, and there will be no closure of any economic activity. In that case, ambiguity would go decline, or it will remain as it is among the investors.
It should be declined. But
Okay. So
sir, realistically speaking, sir, I know you are making an example, but that happened, but it's not working.
Yes, sir. In practical, it will remain.
yeah, so the situation is that you see that government has recently issued a gazette that not gazette, government has issued an order that there will be no closure of the market, or market regulator has also warned that there will be no closure of the market.
Right.
But still people don't want to believe it, right?
True, sir.
Why people don't want to believe it?
Well, sir, past experience, sir. The regulators tend to say something now and they change it a day or two later.
Okay, does it look like people have a conservative bias toward the regulator? Though the regulator was not believable in earlier days, still now, though it may appear that regulator is doing some believable work, but people don't try to believe them.
I get, sir.
So this is a kind of bias. Okay, what I'm trying to say, people do mistake the mistakes are correlated. Why do people make mistakes? Because they have behavioral biases. Okay. Do you know that it is the right time to buy the stock?
True, sir. It's more
At the
cheaper
same
now.
time, a group of institutional high worth investors are buying or are increasing their position. Who are
Yes, sir.
those people?
We have the
Those people are
who have cheap money that they're not going to use in the near future.
those people
Sir,
are
inside traders.
sophisticated and unbiased investors, and they want to make profit by making an arbitrage. You see that they don't, the people who are right now buying, that do not have any superior information to buy, right? By information, what I'm trying to mean, the information from the company, the price
They're just
sensitive
waiting to things
information.
to get better.
There is no
Time.
information, right?
There's
So
there's
they
no
are
information,
not
sir.
making any informative trading. What they are trading, they are trying to make a time arbitrage. Say right now the price goes down, that's why they have taken position today, and they will close out their position say after 6 months. So what they have done here, they have done here the arbitrage. For what reason? They have exploited the
They're just waiting it
mispricing.
out.
They have exploited the mispricing. So what will happen? The fundamental price, what at price at which the stock should trade, that price will be reverted back when? At this time. For what reason? Because the sophisticated arbitrageurs, sophisticated investors, usually institutional investors in developed countries, the hedge fund particular, hedge funds are recognized as the most sophisticated investors in the market. They are present in the market and they tend to exploit the mispricing. And what kind of result it has been they have been able to achieve?
Exceptional return.
They have achieved the abnormal return for themselves, but what they have achieved for the market, market becomes efficient for their action, right? Otherwise, if there were no presence of this kind of unbiased sophisticated investors, what would happen? The price
The
should,
market would be free fall.
after 6 months, even the price should fall in this way.
Right, sir.
Okay, so that is the, that are the three conditions which must be present for the market efficiency and claimed by the proponents of market efficiency. The thing is that we see that pharma has done several studies to see that market is close to efficiency and market tends to be efficient. So there is a way to test this market efficiency. So if the market is not efficient, or if you can come out with any proof or anything which causes to believe that, or there are sufficient reason to believe that you are attacking the market efficiency by a reason or by a point, it is it is recognized that you want to say something about anomaly. You want to say something about the market anomaly. What is market anomaly? What I have said. You are wanting to attack the which concept? Which concept you want to attack? Market efficiency. So if there is a group of researchers have found that there are anomalies in the market because they have proved that market is not efficient as expected. Market is not as efficient as expected. So anomaly proves that market is not efficient. Okay. Now the question is, and there is also evidence that technical trading gives us the abnormal return. That's why people tend to use the technical strategies to exploit or to have a return from the market. But pharma has said that market is efficient, and there is a way that how can you test this, which is known as event study. So what is event study? Just to give you a brief idea, long story short, that say one typical event is the earnings announcement. So typically for every quarter, there should be a quarterly financials to be reported to the market by the listed companies. So I'm trying to term that event as earnings announcement. And there is also event for dividend announcement. And there is also event for stock split or reverse split. And there is also disclosure for changing name and business. And there is also event for expansion. Are you aware of this kind of events in the market for the companies?
Yes, sir. Price
Okay.
sensitive information, sir.
Okay. These are commonly known as price sensitive information.
Price sensitive information.
Okay. Price sensitive information which should be shared with the investors before to make it known to all. Okay. Now the thing is that, what do you think? If the market is efficient, say for example, event date for a particular company, say the event date is 25th March. What do you expect after the disclosure of the event or after the announcement of the event? There should be immediate adjustment to the price.
Theoretically, it's correct, sir.
Theoretically, it is correct. Okay. Now, if it is, say, for example, if it takes 3 or 4 days, as it takes time to spread the information to all the
It
investors,
is the right.
It is
Right,
sufficient to
sir.
believe that at least, say, for example, by 30th March, the price should reflect the new information which has been shared on this date. Can you expect that on the 15th April, prices again get adjusted for this information what has been shared on this date? Is it rational to get
It
adjusted here?
should not be so, sir. Should not be.
Okay. So if a
You're saying
market
that
is
the information has been transmitted.
yeah, if a market is efficient, what you tend to believe? You tend to believe that if it is a positive news, say for example, it is the event date, and there should not be there should not be a good amount of fluctuation or significant fluctuation after the announcement of the event. Say, for example, it may take until 5 days. But if it is T15, we do not expect this, right? We expect that, say, price was here, as it was a positive news. That's why price got adjusted here. And now, as long as there is no other positive or negative information, the price should continue to move in this way, or price should continue to move in this way. This one or this one? What do you think? If market is efficient,
It should be the straight line, sir.
after couple of days of the event date, it is the event date. Even after a couple of days, it may take time, say 3 or 4 days. After this, it should not be. There should not be any more adjustment. Okay. Now, can you tell me, before the event date, people have an expectation that there might be a positive news approaching, or there might be a negative news approaching? People might have
Yes,
this
sir.
kind of expectation.
Yes, sir.
So based on this, by speculation, people engage in trading. Say, for example, Grameenphone will have a declaration in April for the 2020 closure. So April is not here right now. Now, if you want to buy at April, it is likely that you will end up buying the stock at a higher price. So what can you do? You can start taking position in March, speculating that the EPS will be, say, 15 plus. It might be different from 15, but you are expecting that it is close to 15 plus. So that's why there should be some adjustment before the event because of the expectation by the people. Are you with me?
Yes, sir. Okay.
Okay. So if the Grameenphone stock is trading, for example, at this price in this way, say, there should be a prior adjustment. Have you got the reason for this prior adjustment? Have you got the reason for it? And you got the reason
People's
for it.
feelings, uh, pe-
It
people's
is
expectation from
it
it,
is
positive
influenced
or
by
negative.
the people expectation prior to the event, and it is the adjustment for the event what happened on this date by the disclosure of the company. So if you get this kind of picture in the market, what do you believe? The market tends to be efficient, or market is far from efficient? Yes, no.
Market is closer to efficiency.
Okay. So Pharma has exactly got this by taking the event data in 1970s, late 1970s, 1969. He got that the price got adjusted on the event date, and there has been no significant movement after this event date. That's why he concluded that market has semi-strong form of efficiency. Can you recall that what semi-strong form of efficiency calls for? Semi-strong form of efficiency calls for that market price should reflect all available public information in addition to the market information, market historical information, right? Okay. Now let me give other ideas that how event study works. then I will try to share that pharma has got this evidence, but other people have got the different evidence. Okay. Now, how event study is conducted? So you see that have you got the idea of the event? Have you got the idea of the event? Okay. Now, for positive event, what kind of adjustment you expect? Positive adjustment. And if the event is kind of giving some negative information, in that case, negative adjustment is likely. Okay. Now, it is possible, say, to look at the news archive of the stock market, and in US market, there is a site, Edgar, where all the events information are shared by the company to the regulator and to the investors. Do you know where the news is available in our DSC? It is the primary duty of every stock analyst to look at the news and update of the news at every point of time, to update his or her belief. And you see the news archive on my screen.
Yes, sir.
Okay, so if I go to the news archive, and what can I do? Say, for example, uh, I'm interested to look at the news of Robi only. And now I click this search by symbol. All the news are here. All the events are here. Say, for example, the company has further informed that AGM of the company will be held. So it may be an event if there will be some new information may appear from here, and another news regarding the event, another event regarding their spectrum, and another event for their block transaction, and another event for their nomination of the director. Okay, so how event study works? So for all companies, if you are not interested to a particular specific company, you are wanting to be interested on all the information which comes on a particular date or between some date, what can you do? You can click here. These are all the information which have been appeared on today. So you can look at each and every information, and each and every information has value. So our trading must be informative. So how event study works? So in event study, for a particular point of time, say 1972, say 1980, say there are 1,000 firms. So in this way, 1,000 firms have disclosed a good number of events. So when we term event, you have to make a difference between two things. In case of dividend, for example, on a particular day, dividend has been announced, and on another particular day, there has been a record date. These data are different.
Yes, sir.
Okay. What do you think? which date should be the event date between these two for the dividend? Record date or announced date?
Announcement date is the event date, sir. After the announcement is
Okay, the adjustment of price should be linked to this. Investors will change their mind after getting the announcement for the dividend. Okay,
yes, sir.
so you have to think the events what I shared earlier in this way. Usually the announcement date. Say for example, another BSRM Limited. BSRM Limited has said that they will be merged with BSRM. They will be merged with BSRM with their parent company. So which date is the event date? On the date in which they have shared this announcement, or on the date when they will be merged?
That is the event date, sir. When they announced it,
Right.
people will adjust the price after the announcement.
Okay. So in this way, for this period, what authors have collected the events of 1,000 firms in this way. Okay. Now for every quarter, as an analyst, you should have a forecast of the EPS for a particular event. Before the announcement of the event, you should have a forecast that what might be the earnings of the company. Say for example, earnings announcement where the company discloses their EPS. For every earnings disclosure, the analyst have prior expectation. Average analyst has a prior expectation, and there is also average earnings expected by the market. It might be available to the analyst mind, it may not be available to the public, but all analysts have a tendency, or it is the practice also, that they tend to predict what is going to be the EPS declared by the company in this, for example, Q3. So say a particular average expectation of the EPS by the analyst, they have assumed that EPS EPS is likely to be 20 average. And if on the actual event date, the company has disclosed that our earnings plummeted for the COVID, and now we are reporting our earnings 15. Is it a surprise to the analyst?
The price would fall, sir. For
Surprise? Is it a
it's a negative
surprise?
surprise to them.
It is a kind of negative surprise. And at the same time, there can be a situation when there will be a positive surprise. When there will be a positive surprise. So here there is no surprise. Here there are positive surprise. So based on this difference, say the actual EPS, actual earnings, and we subtract the expected EPS. Now the question is how analysts come up with this EPS, the prediction. It can be made by time series analysis, or it can be made by fundamental analysis. What can be? Time series analysis is purely statistical analysis. It can be used in the finance to predict the EPS. Okay. And if you divide this number by the volatility, or standard deviation of the EPS, you will get a metric. Say that metric is surprise. So for 1,000 events, for the 1,000 firms, and for this number of days, this number of periods, for numerous events, we have a long list of earnings surprise. Are you getting it up to this? So that we can continue. Yes, no? I'm not wanting to make you the calculation. I'm just wanting to make the concept to be understandable to you. Is the concept understandable to you? If we calculate this for all the events for 1,000 firms for this period, we will have a long list of earnings surprise. Some earnings will have a positive, some earnings will have a negative.
Yes, sir.
There
Yes.
will be no surprise. Okay. Can we make a sorting out from lowest to highest, from negative to positive?
Yes, sir. Possible, sir.
Okay. Now, can we make a allocation in decile? How many deciles we will get? 10 deciles. We know quartile, decile, these things. So these are the first decile, these are the second decile, these are third, these are fourth, these are fifth, sixth, seventh. So in this way, 10th decile. So this decile contains which companies? The companies which shared the earnings less than
Surprise
the
just the most.
expected. That's why their earnings provided negative surprise. These companies are in this decile. And which companies are in the 10th decile? The companies which have recorded the highest positive surprise. Are you with me?
Yes,
Okay, fine.
sir.
Okay. Now you can make a you have made a sorting, and you have grouped the companies. And at the same time, for this group, what you have done, you have seen what happened to the abnormal return for this group, what happened to the abnormal return for this group, what happened to the abnormal return for this group, and in this way for 10. And we can also calculate the cumulative abnormal return by looking at the time. If we look at a group of companies, and first of all, we will get average and abnormal return, because there are a group of companies, group of events here, and we can also find out the cumulative abnormal return. And if you understand the event study, and if the market are efficient enough, what do you expect? Say, if I want to draw the line like the graph I drew before, this is the event date t equal to 0. This line should be like this if the market is efficient. You see, for this company, say it is for the 10th decile, this one, the last one, it is for the 10th decile, it is for the first decile. As these events are positive, that's why abnormal return is not abnormal return, the return is positive, right? the return of the stock is positive. But this group which disclose the negative, that's why the return is negative. But after the adjustment, if the market is efficient, they tend to be moved in this way because it has already been adjusted up to this, right? Are you getting? I'm getting no sound from here. I see no person is there.
Yes.
Okay. What do you expect? This straight line, or you expect that it tends to continue in this way, 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 it tends to continue in this way. If it is true, this long adjustment after long days, will the market be efficient or market be inefficient? Shajat, you are there? Shajat Hussain? Shajat Hussain, you are there? How should market react? Market should react positively for positive event, and market should react negatively for negative event. And if the
Yes,
market
sir.
is efficient, their market reaction should be limited to a very adjacent date to the event date. There should not be adjustment after the adjacent date. Say it has been 4 or 5 days, but after 4 or 5 days, if still market adjust for this news, this event, market does not tend to behave efficiently. Are you getting this point? So that I can show you the evidence. Either can be true. You just have seen what Pharma has found. Are you connected with me?
Yes, sir.
Yes, sir. I got the point, but sir, what is you are actually trying to say? I mean, what should I get from this assumption?
Okay, I just want to say that what is going to happen if the market is not efficient. Behavioral finance has challenged the market efficiency. Neoclassical finance has assumed that market is efficient, but behavioral finance has challenged the concept of market efficiency. Behavioral finance has said that market is not as efficient as expected. Have we got it up to this?
Yes, sir.
Okay. Now let me show you the proof. Close this. Okay.
Sir, in exam, do we need to provide proofs or basic analysis is enough to get marks?
You have to share the concept, not the technical things. What I am trying to explain to understand the things, to understand the conceptual things.
Okay, sir.
Okay. So it has been studied by Ball and Brown, and they have found that even after the few days of the event date, return or stock price tends to move upward for positive earnings surprise, and stock price tend to move negatively for negative earnings surprise, and it continues to drift for several months, not several days. Remember, how many several months. And for which market? The US market. And you see the graph, what they have found. You see even after the event date is here. Event date is the vertical line. What is the reason for this adjustment, upward adjustment from here to here? What are the reason? In vertical, there are number of days before the event date and after the event date. And in horizontal axis, and in vertical axis, we are representing the cumulative abnormal return. And if the market is efficient, this line should be a straight line from this point at least. But we see that line goes upward for long months, the line goes downward for negative surprise, negative earnings surprise companies or negative surprise events. You see the decline continues for long months. You see there is a 50 or 30. It is 50.
People's expectation changes actually after the negative surprise or positive surprise. In the coming days, they tend to be more positive, optimistic about the company, or the negatively impacted by the previous surprises.
Their adjustment should be constant by this time, because they have disclosed a particular negative event, for example. So you have to think of the whole story on that point of time, or you will take 6 months to think of it. What do you think? Will the market give you the
Mostly at
return
that point of time, at
huh?
the time of the event, sir.
At the
At
time
the
of the
time of the
event, or
event,
you
I
may
will take
take either 3 or 4
advantage.
days maximum?
Right, sir.
You will not, obviously you will not take 6 months, 5 months, 4 months. And
To take action, no, sir.
it is not for the individual
No,
investors,
sir.
it is for the aggregate market. Market continues to give the higher return for positive earnings companies for up to several months, up to 3 to 4 months. You see, up to several months. And market continues to penalize the company who disclose the negative surprise up to several months. You see? So what do you think? Pharma was correct? What you showed earlier here in 1969? Here. Okay. So we have got the evidence that the earnings continue to drift upward, continue to drift downward for several months, and this is known as shortly PEAD, post earnings announcement drift. Okay, so it is evidence for what? It is evidence that market is not as efficient as expected. Okay, now there are challenges to test the market efficiency. There are two challenges. So are you familiar with the concept of abnormal return? In the concept of market efficiency, you have learned that there will not be possibility for achieving abnormal return. Can anyone tell me, have you learned what about the abnormal return? Or what is normal return, in fact? So that we can talk about the abnormal return.
Sir, expected return is that we can say that's a normal return or unexpected one.
Okay. So how can we
The total market return or index return is the normal return.
how can we define expected return?
More than that or less than that?
We can define expected return in this way.
Index return or market return, sir.
We define expected return in this way. If there is a noise, please keep your microphone silent. Would you put your microphone in silence if you don't want to speak in class? Okay. So this one is the expected return. Now, which is the portion of expected return actually? This portion is the expected return. And you see this portion, here is the alpha, there is the alpha. And from where I have written this? Can you recall that what CAPM says? CAPM says the excess return should be directly proportional to the beta or the market risk premium, excess return of a stock. What do you think? What beta has said? Sorry, what CAPM has said?
Yes, sir.
CAPM has said market excess return of a stock is directly proportional to market risk premium, or excess return of a stock is directly proportional to beta of the stock.
Beta of the stock, sir. If I'm talking about return of stock, the beta of
This
stock.
remain constant for all stocks. This portion remain constant for all stocks.
Yes, sir. The market is constant
Which
for
varies.
all stocks. Market
So
risk
it is the
constant.
proportionality factor, and it is the way, it is the beta to which market excess return of a stock is directly proportional. And what CAPM has said that the return of a stock can be explained by the beta itself. Beta represents the all systematic risk factors, and one should not, when pharma has said that one should not have abnormal return, pharma has claimed that there should not be return more than the return expected by asset pricing model. This one is one of the return estimation by the capital asset pricing model. And say you have market return is say 4%, and for a particular stock, beta is 2. How much expected return is normal? How much return is normal? 8% return is normal. But if someone receives 12% return, how much return is abnormal?
4% is abnormal return, sir.
4% is abnormal. For what reason? Because the additional 4% return cannot be explained by this asset pricing model. Have you got it? Now the thing is that it has been found that the capital asset pricing model beta, or CAPM beta, does not reflect all the risk factors which can be attributable to the stock. Pharma and friends wrote paper in 1993 where they discovered that in addition to the beta, the companies or the stock sensitiveness to the size and also to the value also account for the expected return. what they have assumed that there should be a size beta, there should be a value beta, and there should be a return premium, risk premium for size factor, there should be a risk premium for the value factor. How many factors? Two additional factors I have added. How many? Two additional factors I have added. This is known as the Farmer-French three-factor model. This is known as Farmer-French three-factor model. This is another asset pricing model. Now say, when you have used this model, you are seeing that your expected return should be 12%. I will explain it after some moments. What is the size premium? What is the value premium? Say, for example, when you have used this asset pricing model, you are seeing that expected return is how much? 12%. In that case, how much is abnormal return? How much is abnormal return if you still achieve
Here
the
is the
12%
4%.
return? Huh? When you have used this
4%.
asset pricing model,
0%.
0%.
0%. 0%.
Now you see
Yes,
the
sir.
abnormal return, what I have estimated earlier, was the reason for market was inefficient, or for the reason for using asset pricing model which does not account for all risk factors. What do you think? How this 4% appear here, how this 4% disappear here, the abnormal return?
Because of market efficiency, sir.
How market efficiency? I have not talked anything about market efficiency here. I just have talked about asset pricing model. One is capital asset pricing model, another one is Farmer-French three-factor model.
Before we do not consider the risk factors.
Right, because we have not accounted for two other risk factors what have been added by the Farmer-French, right? So there are challenges in testing the market efficiency. There are challenges in testing the market efficiency because there are joint tests. There are joint tests. So what is joint test? You probably have heard about the test of hypothesis, right? In your statistics course, test of hypothesis.
Yes, sir.
I'm trying to refer joint test as joint test means two tests of hypothesis you have to compare. So say one hypothesis is that the asset pricing model what you are using to test the market efficiency is appropriate. The asset pricing model is appropriate. And another hypothesis is that market is efficient. Say, now if you want to prove that a particular market is inefficient, how many hypotheses you have to prove false? Two or one? You have to prove two hypotheses false. How? Two, I mean the null hypothesis. You see, you have to prove first the asset pricing model is appropriate. If you can prove it, you have got 1 point, that your task is 50% done. But you cannot conclude anything about the market is efficient or market is inefficient just by saying that asset pricing model is appropriate or inappropriate. So say you have found that your asset pricing model is appropriate. Second thing, you have to prove that market is efficient or inefficient. Can you recall that we just have seen the evidence of even a study to prove market is efficient or inefficient? This one is one of the This one reflects what? Market is efficient or inefficient? We already have discussed about it. Market is efficient or inefficient from this graph, what we have seen. Did by Pharma.
Efficient.
Efficient, but we see the different picture here. Market is not efficient because the price adjustment continues to long for long months. That's why these findings is reflecting that market is not efficient. Okay, so if you can prove this that market is not efficient because there has been price adjustment even after the event date, in that case your task is another 50% done. So how many tests you need to check? One thing is that your asset pricing model is not inappropriate. Your asset pricing model is not inappropriate. This is the first null hypothesis. Second null hypothesis is that market is not efficient. Okay, so we have found evidence that about the post earnings announcement gift. So take a strategy. If you buy the stock of this group, which stocks are in this group? The stocks which has shared the positive earnings surprise. It is the 10th decile. 10th decile. We have started from the negative surprise to positive surprise. So the lowest one is the first, and the positive highest positive is the 10th decile. Okay, so if it continues, what do you think? Okay, it will be better to write in opposite direction. Here it is the 10th, here it is the first decile. Now if it happens actually, what will you do to make profit? The fund manager,
Yes, sir.
what will you do if it really happens?
Little confused, sir. Yes.
Why you are confused? The companies which are disclosing positive earnings surprise, they are continue to
Go after.
rise for a long months, right?
Right.
So in that case, you like to buy this position or you like to short this position?
I'd like to buy this position because
You like to long this position?
Right, sir.
Okay. For how many months? Up to this number of days? Say, for example, here it is for 70 days. So in that case, how many months? 3 months or 2.5 months? How long you will continue to hold it? For 2.5 years, not 2.5 years. For the number of
I'll
months.
continue to hold it until there is another positive surprise.
Right. Okay. Until the exact answer is that until this adjustment continues. Okay. You have an evidence that this adjustment continues for long 60 days. For example, here it is 50, it is say 60. So 60 means 2 months. And at the same time, what will you do for this group of stocks?
I need to sell, sir.
You need to short this position.
Yes, sir.
Now you see, if you long this group and if you short this group, do you expect that you will have a return, positive return?
Yes, sir.
So in this way, which people exploit this kind of mispricing? Arbitrator exploit this kind of mispricing in this way. Okay, so this kind of return cannot be explained by the CAPM because there has been no changes in beta. the differences in return, why it is causing. Okay, can you tell me a convincing reason why people continue to put higher and higher price for the event which happened here? People know that this event actually happened here, but still people want to pay a higher price at this point after 2 months. For what reason?
They expect that it will happen again.
People are overexcited. People are overexcited. And what happened here? People are also overexcited with the negative surprise. Okay, overexcitement is not always positive, or it can be positive sense, it can be negative sense. So overexcitement is not the term used in the behavioral finance. It is used as overreaction. The term is overreaction. People tend to overly react for the positive event, and people tend to overly react also for negative event. And how long it continues? It continues for several months. Okay, let's continue. And what are other evidences which showed that market is not as efficient as expected? Okay, second one, size. Are you familiar with the market cap term?
Market cap. Yes, sir.
Yeah. What does it mean?
The total value of all stocks trading in the market.
Total value of all stocks.
Trading in the market.
All stocks or all float? Okay, all floating stocks.
Or if I'm talking about a particular stock, the total. Right, sir.
Floating, right?
Sir, when market cap is a free float market cap and total market cap is different. Free float market cap is only tradable one.
When it is free float, in that case, we just want to look at the stocks which freely float, which float
Tradable, sir. Right.
which are tradable. Okay, which are not under the hand of sponsors.
Any type of.
Yeah. Okay. Now, is it possible that we can sort out the companies by the market cap from smallest capital to largest capital? Is it possible?
Yes, sir.
Okay.
Done.
Yeah, it can be sorted. Can you give me example of a very small cap company from our market?
For small cap companies are mostly sir, let's say the Aziz Pipes and sir, I'm not going to about talk about the small caps a lot, but those are mostly loss making concerns, because by over the time their capital was good, but the share price fallen to a level that made them really small cap companies.
Okay, when you will just finish this
Also, there's
lecture,
some
your
insurance companies that
perception will
have
change.
like 50.
Okay. When you
Okay,
will
sir.
just finish this lecture today, your perception will change. Okay. You see, so we have got one company in the category of a small. Okay, what we have done based on the market cap, we are sorting the stocks. And here we can take Robi, we can take Walton, these companies, right?
Yes, sir. Grabbing phone.
Okay. Now, is it possible to make a decile these groups? To make a decile, deciles group companies or group observations in how many groups? Deciling 10 groups.
So mostly small, mid, and large
Oh, no, not a small, medium, large.
caps
I'm
are
just
used to classify.
most smallest, then small, again a small, in this way. Small, medium, large. In this way, how many groups? 10 groups,
10 groups. Okay.
10 deciles. So it is possible to group all these companies into 10 deciles. Okay. Now it has been found by Pharma friends in their 1993 paper, the cross section of stock and bond return. The cross section of stock and bond return. If I want to show you the paper, if I'm not wrong with the title of the paper, this is most seminal paper. Okay, common risk factors. Okay, this one. How many citations you are getting for this? You see the number highlighted?
2,50,086.
Is it huge?
Huge certificate.
Okay. So this paper is one of the few papers what all finance people should read out. Okay. So they have found that, okay, let me show you the result. That's in that case, it will be clear to you. Okay. They have grouped the companies into 5 deciles, not 5 quintiles. So when it is 5 groups, in that case, it is not okay, this one. It is not decile, it is quintile. And when it is 4 groups, we say it is quartile. First quartile, second quartile, third quartile. Okay. You see what they have done? They have grouped the companies into how many groups? 5, from small to big. And they have observed the mean excess return. How many portfolios they have formed? 25. I will explain the what have been presented in the horizontal later. Just try to understand based on the size quintal, they have allocated the companies into how many groups? 5 groups, from small to big. And they have observed the excess return of by looking at the 25 portfolios which have been formed using the size and also the value. I will talk about value later. Okay. You compare, this one is 0.39% and a monthly return 0.44%, 0.43, 0.48, 0.440. Okay. Now just look at this column, look at this column, look at this column, look at this column, and look at this column. And now tell me which companies tend to give higher monthly return, small companies or big companies? Just look
Small
at
cap
this.
companies, sir.
Huh?
Small cap companies.
Okay. And what about the big companies? Big companies are providing
They are
equivalent or
generating lower return.
lower?
Lower return.
average return of the
Lower,
big
sir.
companies are lower. As we move from the small to big, we see the average return in this group tend to go up here from 0.39 to 0.4, but there is a randomness here. But we see here consistently the big companies are providing lowest return, the smallest companies are providing highest return, and this is true for here, this is true for here, this is true for here. Now, what will be the profitable strategy? To buy small stock and to sell big stock?
Not really. That create a higher riskier portfolios.
Okay. Now, Pharma has showed that the strategy where we long the small group and short the big group, big, small, based on what? Based on what?
Market cap.
Market cap. Will give monthly. Okay. It is a Pharma or other paper. Okay. How much return from this difference from a small to large?
4%.
4%.
4%.
Probably it
Sir.
is annual. Probably it is annual. It should not be monthly, this big number. Okay. So portfolio consisting on the smallest decile of the New York Stock Exchange stocks outperform the largest decile portfolio by 4% over how many periods? You see the how many years from 1926 to
70 years.
1996. So you see which companies are providing higher return, which investments are providing higher return, investment in a small firm or investment in large firm?
Small cap firms.
A small cap firm, and it cannot be explained by the CAPM beta. It cannot be explained by the CAPM beta. Okay. Now you see what is the reason why small cap stocks provide higher return and still now it is providing higher return? It is not that it has not become, it has not been history that 1926 to 19 in Pharma paper you see that for how many years they have found it. It is probably from 1926 to 1993 most probably, or 1992. Can you tell me what is the reason why small stocks give higher return relative to the big stocks?
Think of the chance of both.
Hmm?
The chance of both and liquidity premium.
Liquidity is for liquidity. You are just looking at the size now. You are not looking at the liquidity. Why size of the small stock should, or size of the company should matter? Okay, just to give you the plausible one reason, there are so many debate that is there behavioral reason or there are anything wrong in the what Pharma use the CAPM. They have found that CAPM beta does not explain this difference between the small and large company return. So still small companies provide higher return relative to the large companies. Okay. Yeah, during this COVID pandemic, which companies becomes more riskier? Okay, apart from the COVID pandemic, which companies are more riskier? Smaller or larger?
Small caps, sir.
A small cap. So what finance has taught you, you should expect higher return for assuming
High risk.
higher risk or lower risk?
High risk.
Higher risk. So this is one of the plausible reason, as you are assuming higher risk associated with a small cap, That's why you are getting higher return. And another plausible reason what I tend to like convince you, okay, most people are crowded in these stocks or in these stocks,
Crowded in large cap, sir.
large cap stock. What is the reason?
They are risk averse.
Okay, if most people are crowded here, these
Safety and
stocks,
the growth is
huh? These stocks tend to be inflated.
yes.
If most
But
people make crowd here, what will happen? What tend to happen?
the demand side will go up, but supply won't.
Yeah,
So
in
the
that case,
price will increase.
yeah. And what about here? People don't care. People don't care about these companies. But it is not like that. The small companies are all together. Uh, I mean, the bad companies, right? Okay, they are
Correct, sir.
small in terms of their size. Okay, so the crowd of the people or the crowd of the investors is less here, right? So they tend to be inflated or deflated their price.
Deflated, sir.
Okay, this is another reason. And another reason can be uh, if the market is, it has been found that market efficiency differs from company to company. The which companies are more responsible to the investors? Large companies or small companies?
Responsible.
Which
Large companies
companies are
are
more responsible, more accountable to the investors?
more responsible, sir.
Okay.
In case of disclosures.
Now, what do you think? The information for large companies are largely available, or the information for small companies are largely available?
Large companies are largely available, sir.
Okay. In that case, there is less scope for speculation and making a speculative return, or there is more speculation probability and more probability for making a speculative return. If there is small information available, there is more information available.
But the information is less, it's more likely to have a return.
It is more likely.
Yes, sir.
Have you got the reasons? There are convincing reason supporting and also against that why a small stock should provide higher return. Still, small stock is providing higher return. Okay, so you see one of the, okay, I don't want to stress more on size issue, and you just see that what happened, and the size effect is here. And I like to conclude just by saying another factor what is related to or what is similar to size, that is the value. Okay, what does value mean here? Are you familiar with this? Price to market value. Oh, okay, price to earnings.
Commonly used parameter for valuing a stock, P
Very
ratio.
commonly. Okay, now by price what we represent? Market value. And by if we
Earnings, EPS.
keep here book value, if we keep here book value, and if we just reverse this, inverse this here, just opposite of each one. Okay, and this concept is known as value. value metric. Okay. Now you see some companies are traded at a very high multiple in terms of it, and some companies are trading at a very low multiple for it. Usually the companies which are traded at a very high price relative to their earnings, they tend to be also the companies which trade at a high market value relative to their book values. Can you tell me what is the reason why their market value tends to be very high relative to their book value? Why investors want to pay very high for these companies?
Return on equity is higher.
Return on equity can be higher. What is investors' expectation? If return on equity is higher, can you recall that we can also form the growth rate by retention rate multiplied by return on equity? Are you familiar with this?
Yes, sir.
Okay. So investors tend to believe that this company is likely to be growth company. That's why we should pay more for this company. And what happens if this is low for a company? Is there any company in our stock market of which market value is lower relative to the book value?
Many companies, sir.
Many.
Many.
Okay. What is the reason?
Return on equity is very low, sir. The earnings is very low.
Their potential for growth is expected to be very low. Okay. So the thing is that the companies which are in this group, I mean high value. Okay. Remember, it is not the value metric. This is the high value. Okay. Of which book value is higher, market value is lower. Just the opposite of the metric what we just have removed. Okay. So it has been found that if we sort the companies based on this metric, are these available to calculate book value per share, market value per share, or book value of the companies divided by market value of companies? Is it possible to calculate?
Yeah.
It comes from where? Market, or it comes from balance sheet, financial position? It comes from the statement of financial position. It comes from the market. Okay. Now it has been found that if we sort the companies from high value to low value, this group tends to provide higher return relative to this group in long run. Now you see, this group tend to provide higher return, high value stock. This group tend to provide lower return relative to this stock, just because of what? Because their book value to market value is higher and their book value to market value is lower. And do you think it should happen if the market is efficient, or it happens because market is not as efficient as expected? You see, if you form portfolios where you have included the stocks which have higher market to book ratio, have earned lower return than those with low ratios, just the opposite what I just have mentioned here. Okay, so just inverse this one. Which stocks provide higher return? The stocks which have higher book to market, they provide higher return. And if you make a long short, which stocks you will long those stocks which provide which has higher book to market value, and short which stock which has lower book to market. It provides you how much return? 12 to 15% per year. Is it significant return? Is it significant? And you just want to see the proof. Are you there?
Yes, sir.
Yes, sir.
Sir.
Okay. So you just want to see the proof. You see the Pharma French paper, and on the same table, what I showed you earlier, just few minutes ago, I have to revise. Okay, I have to rotate this. Okay. Now, what is the sorting? Based on the book to market. You see, have you got it? Now, the horizontal one. Okay. So low to high. So which groups will provide higher return? The group which have high book to market or low book to market. What we have learned from here? High book to market or low book to market? Which are high value stock? Which have high book to market, right? Which have high book to market. Okay, you see, you just compare now in this direction. The selection is not appropriate. Okay, it will be better if I take the annotation from here. Okay, you compare in this direction. You see which groups are providing higher return. The companies which have high book to market or low book to market.
High book to market.
High book to market. What comes in your mind? What might be the reason for this anomaly? Why high book to market provides higher return? Why high book to market provides higher return? Okay. Have you heard about the popular statement from Warren Buffett that make profit when you buy, not make profit when you sell? This kind of a statement. Buy a stock which is cheap or buy a stock which is expensive and sell the stock again at expensive price. What is the suggestion from the Buffett? Make profit when you buy or when you sell?
Make profit when you buy.
When you buy. So if you want to make profit when you buy, you should buy at a higher price or buy at a lower price. Lower price. Okay. Now between uh, the companies which have a low book to market, they tend to be underpriced or they tend to be overpriced. The companies which have a
Overpriced. Overpriced, sir.
they tend to be overpriced. The companies which have a low book to market, right?
Right, sir.
Okay. So it has been found that people end up buying stocks at a higher price because they believe that those stocks are growth stocks and growth stocks are expensive. Growth stocks are expensive stocks. That's why they end up buying the stocks at a higher price. But if they do the opposite, what would happen? Their return, and they make a long short, their return will be 12 to 15% per year. Okay. And this return, what has been yielding, just for what reason? Just for differences in the book to market ratio, cannot be explained by the CAPM. Okay. So that is all about for today. We just have seen some evidences for for what we have seen that market efficiency do not work